Victoria, it's a pleasure to chat with you again. I know you remain, I don't want to say skeptical, but certainly vigilant when it comes to these markets. But it appears the juggernaut that existed before, this whole pandemic thing appears to be continuing. What's going on with the market? You can't stop it.
Right. And I think a lot of that can be attributed to the Fed put per se. I mean, the amount of liquidity being thrown into the markets, stimulus checks to individuals has really provided a support level that's allowed this market to really outstrip where the data says it should be. Any way you look at it, it looks a little expensive, right? About 22 times earnings. Earnings are very hit or miss on where it's actually going to show up. So we start looking at some of this data, the number of unemployed we have, where the market's trading, and I can't make the argument that the fundamental support, the market trading back where it was pre-pandemic, basically, back where it was in December 2019. So I just think this market is really in front of where the data thinks it should be, and just not the time to be chasing risk right now.
Okay, don't chase risk. I mean, yeah, as I've said before and tweeted out, I'm nervous about the job market in June of 2021, not this year, because of all the backstops from the government. Here's the issue about the stock market, Victoria. When you look at sort of the returns, now maybe it's just the ETF effect. You buy an ETF and you buy everything. But we just did a segment on LBOs and leveraged companies. Companies that have terrible balance sheets. I'm not going to name any names, but horrible balance sheets. They're going well as well. The market and buyers don't seem to care about the strength or weakness of a company's income statement or balance sheet right now for some reason.
Right. And I think Rich Bernstein actually put it really well when he said it's right now everybody's getting participation trophies. So doesn't matter how good or bad you are at, a rising tide lifting all boats. I tend to argue it is going to matter. We're hitting a little bit of a more uncertain patch, right? Everybody needs to pay their taxes July 15th. We're in a contentious election year. A second round of stimulus might be a little bit harder to get through. And I know there's talk of another round of checks going out, but 5 months out from an election, it might be a little more difficult to get everybody on the same page. So yes, the beta rally has been real. I mean, look at Hertz, the people that piled into the stock that's going bankrupt. And so you look at some of this and you have to say, do I like what I own? Do I understand what I own? And this might be, a short-term, power boost to some of these low-quality stocks. But you got to really rely on owning a company you feel comfortable owning. At some point, quality is going to matter because at some point, all of these little extra pieces of help you're getting from the Fed, they're just going to fall away and you're going to be left owning junk.
So I've got about 30 seconds left, Victoria. So give us an idea. Where do we go now? What looks good to you? What's not junk in your parlance?
Right. We're large cap, U.S. quality, all of the non-junky attributes we tend to look at. That's where we're focusing. We like a couple defense stocks, tower REITs, a few select technology sectors, things with repeatable revenues, things that are not too COVID sensitive, and things with good balance sheets. It's boring, but that's where I really think you should be looking and not chasing down the risk spectrum as people have been.